I was having a grand old time in the summer of 2020, making the most amount of money that I had ever seen in options trading, taking win after win after win, until Tesla decided to screw that up for me, and I took a $12,000 loss. Welcome back to Everything Options. My name is Greg, and today I'm going to be talking about my $12,000 Tesla options loss. So to break this video down for you, first I'm going to talk about the thought process behind this trade as I was opening it and as I was going through this massive loss. Then I'm going to talk about the strategy that I used, and finally at the end of this video, this is probably going to be the most important part, what I learned from this trade. And all of this is to help make sure that you don't make the same mistake as I did and pay $12,000 in market tuition. So if you appreciate that, make sure to leave a like down below, and maybe we can get this video to 12,000 likes. That way we can make up for this loss. So my thought process behind this trade, it all started on a cool breezy day in September 1st. This was the peak of the bull rally back in September of 2020. And pretty much every tech stock that you could think of, anything that was related to tech or electric vehicles or really anything revolutionary, was just going up in price like no other. And honestly, I can tell you that I didn't see an end to this bull rally. In fact, I was extremely bullish on Tesla because Tesla's battery day was just around the corner in 3 weeks on September 22nd. There was rumors that they were going to announce the million-mile battery, that they would announce the price parity with ICE vehicles, which is $100 per kilowatt hour, and there was a lot of hype and a lot of rumors surrounding this event, and I was super excited about it, so that's why I entered this trade when I did. I put down $12,000 for this trade, and I was expecting an absolutely huge move out of Tesla on battery day. At the time, it was trading for around $400 or so, and I expected it to be above $600 within just 1 month. And I'll get into the strategy later on in the video, but the gist of it is that I expected 50% just based on one catalyst, that was battery day. Well, legend had it that battery day was an absolute bust for investors, at least at the time. Of course, Tesla has gone up since then, but my options only expired about a week after battery day. And I remember watching this event on the big TV. I had my laptop pulled up beside me. I was watching Thinkorswim back here, and I was expecting Tesla to make this huge move up during the event, but then, well, the opposite happened. That $12,000 that I had put down on this trade represented about 30% of my portfolio. Back then, I only had about $37,000 to my name, and this is my life savings that I had on the line here. And I put $12,000 of that into just one option that could have gone to zero. And you'll learn later that it did, and exactly how it did that. And after all I had been through on battery day, even after it fell by probably as much as 80% for these options, I did what any sensible person would, and I bought more of this. And I kept adding onto the stack and taking on more risk whenever I was opening this trade. And this definitely was money that I was willing to risk. And before we get into the strategy that I use, if you want to see what options I'm trading every day, I post all my trade alerts to my premium Discord. You can find that at my Patreon, which is going to be linked down in the pinned comment below. So as hard as this is to look back on, the first trade that I initiated was a call debit spread for $2,800 for a $500 strike price and a $600 strike price, expiring on October 2nd, 2020. Remember, I opened this on September 1st, and at the time, Tesla was going for around $400. So I was expecting up to 50% upside on Tesla stock within just 1 month. And this would have been fine if I had just stopped here with $2,800, because this was just about the usual amount that I was putting down for each option. But of course, I was super excited about it, so I put more money down. I put another $2,400 down on this trade. So at this point, I had $5,200. But of course, it didn't stop there. I put more money down. I put another one for $2,200 here, and then you can see I bought two more that went for $2,000 each. So at this point, if anybody's keeping tabs, I have about $11,500 locked up into these call debit spreads on Tesla, betting on it going up by as much as 50%. This was my lottery ticket. I thought that this trade would take me to the $100,000 mark, but of course, as history had it, that wasn't the case for me. But of course, I'm still overly optimistic about my trade, so naturally, I bought another one. And at this point, these options were going for $670. Remember, the last ones we bought for $2,000. So at this point, I had lost about 66% of this trade, but I was still optimistic about it. I still thought that Tesla could make a rebound. Battery day, again, was around the corner in just a couple weeks at this point. And then the next move that I made was probably the most sensible thing that I had ever done. So I decided to actually take profit on just one of these call debit spreads, and I sold this for $2,060. You can see the position effect is to close it. So I sold this for $2,060, and then my next move was selling another one for $7,700. And at this point, I was actually at a profit. My average cost per trade was about $1,500 per each of these debit spreads. So if I had taken profit at this point, I would have been up by as much as about 25%. And I should have been happy with that, but I wasn't. So what did I do next? Of course, I bought more. Tesla had gone down to this point. Battery day was the same day. It was on September 22nd. I was extremely excited about it. So I bought another one for $1,325. I bought another one for $1,125. I bought another one for $1,040, and this was the main event that I was extremely ready for. I thought they were going to make some big announcements. I thought Tesla stock was going to go to the moon, but, well, history had it that it didn't. And a couple days after Battery Day had passed, these options were now going for $216. The last one that I had bought was $1,040. So at this point from here, these options were down by as much as 80%. I think on all the options combined, I was down probably by about 90%. But for some reason, even though this option only had about a week until its expiration date, I still thought there was a chance that maybe, just maybe, Tesla could be above $500. But again, it was still trading around the $400 mark even when I was opening this trade. And I had about 10 total call debit spreads on Tesla. I had a week until the expiration date, and I should have cut my losses here because I still had probably around $1,000 in this trade at this point, but I was willing to risk $12,000, so what's another $1,000, right? And that's where I stopped. So at the end of this, on October 2nd, spoiler alert, Tesla was not above $500 on my expiration date. So these options expired completely worthless. And this is what I learned from this trade. The first thing that I learned, which is probably the most important lesson from this trade, was not to put as much money down, especially on such a risky play. This was an out-of-the-money call debit spread, meaning that I was already at a disadvantage whenever I opened it, and I should have known going in that I could lose the entire $10,000 if this trade went south on me. But I wasn't really thinking about that. I was more so thinking about the $70,000 that I could have made from this trade. Keep in mind, my average trade during this time was between about $2,000 to about $3,000. So this was about 3 to 4 times bigger than any trade I had ever opened before. I should have scaled up to that rather than just going all in on this single option. So that is another lesson that I learned from this. Another lesson that I learned from this is not to put a lot of money down on options trading. I remember back then I was putting between about 30 to 50% of my entire portfolio in options trading, whereas right now I only use about 10 to 15% of my account. While I'm not putting as much money down and I can't make as much return, it's going to be a lot safer if my trades go completely south on me. And now I'm using more safer strategies and I'm more diversified in the types of options that I'm opening. So that's another key point here. I should have known going into this trade and with any options trade that you can lose as much as you put down in the trade. So I wasn't willing to lose $12,000, but I put it down anyway because I thought this would be like a lottery ticket to where I can make a crap ton of money. And even towards the end of my trade, I was just overly bullish for some reason. Tesla was trading at around $400 and I still expected it to be above about $520 even for me to just break even on this trade, which was absolutely just wishful thinking. What I should have done instead here was whenever I knew that this trade was going south on me, when I didn't have pretty much any chance of a recovery, that's when I should have closed out of this trade. I think I had about $1,000 or so a week before these options expired, so I should have kept that $1,000 to myself. Or an even better option would have been to take profits early on, because you remember I was up by $4,000 at one point on this trade, to where I turned about $8,000 into $12,000. So I should have just settled with the $4,000 profit rather than waiting for this big move, expecting to make $70,000 for this trade. So my takeaways from this loss that I'd like to pass on to you is size your positions according to the trade. If you're uncomfortable with your max loss scenario, then maybe reduce your risk a little bit here. Second, whenever you're up on a trade, even if it's just by a marginal amount, make sure to take at least some of your profits. That way you get to pay yourself with the profits that you made, and that doesn't go to waste if the trade goes south on you. Generally, the odds are going to be stacked against your favor whenever you're trading options because they lose value with time. So the longer you hold your option, the more money you're going to lose unless you're on the selling end of them. This is especially the case whenever it comes to out of the money options because you're already starting at a disadvantage. With the option being out of the money, if it expires out of the money, it expires completely worthless. So if the stock never crosses above your strike prices and you're long on those options, you're going to lose all your money if you hold into the expiration date. Whenever I first opened this option, I only had about a month until the expiration date. Remember, I opened it on September 1st and it expired, I think, on October 2nd. So I only had 30 days or 31 days in order for Tesla to go up by as much as 50%. That was just wishful thinking on my part. As of lately, after taking this huge loss and learning my lessons, my average win rate is about 70 to 85% of my options are profitable, and my average return per option is sitting somewhere between about 20 to about 30%. So I'm doing pretty good now, and I'm glad that I learned these lessons, and I'm glad that I can teach them to you. And if you appreciate this, make sure to subscribe to the channel. Thanks for making it all the way to the end of this video, and thank you to all my patrons for the support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.